This is going to be a really good presentation, guys. I got a sneak peek of it, and it was very enjoyable. So it was good. So Gary B. I'm not going to use Gary's full last name because depending on how things go, he might not want you showing up on his doorstep.
It's on the first slide.
Oh, okay. Well, it's on the first slide. So Gary, so Gary is actually not an AmiBroker user. I know Gary from the various local trading communities and from JB's group. And actually, I think we met quite a few years ago when I had my trading room open. I remember going for a coffee and chatting about trading and getting together once in a while, even back then. So we've known each other for a few years. Gary and I go out for lunch once in a while to just catch up on what's going on with systematic trading and things like that. So Gary is not only a good guy, but he is a systematic trader and investor with a technology background that has allowed him to build the necessary technology tools and processes to evaluate his trading ideas. Gary specifically uses C#, but he has a technical background, so I'm sure he could probably use any programming language. So from starting out, as most of us do as a discretionary trader, Gary decided that there was a much better path to success. This experience has led Gary into recently fully automating his short-term trading strategies with better consistency and good success. Gary will not only cover the good stuff, but the challenges he's faced and how he's been able to deal with them along the way.
So this presentation evolved from a whole lot of time and effort over the last few years of trying to come up with strategies that I had some faith in, and basically the metrics I used to evaluate those strategies and to come to the conclusion that I want to commit some money to those strategies. So of course there's a disclaimer. Similar to Dave's, this is for educational purposes only. I may talk about certain stocks or investments in this presentation, but that's not intended as advice. Dave has the PDF for this. So this slide serves as basically a table of contents. So this is all hyperlinked. You can use this to link to any portion of the presentation you want. So it's really more for information purposes. Okay, so a little bit of background first. I'm sure everybody here is familiar with backtesting if you're using AmiBroker. But basically, backtesting is the process of applying a trading strategy or analytical method to historical data to see how the strategy or method would have performed. So basically using historical data to test a strategy over a particular period in time. And the longer the time period, the more possible scenarios that are tested, and the more market conditions that are tested, and the more meaningful and useful the results will be. Just a little bit about my personal background and experience. I've been investing for over 20 years. About 10 years ago, I decided to move all my money into my own self-directed accounts so that I could manage it myself. And then within the last 5 years or so, I've been creating my own backtesting software, doing portfolio management, coming up with different ways of selecting stocks for different strategies. And basically at this point in time, I'm at a stage where it's working well. I've been able to fully automate it. And I'm able to use the signals generated from my software to automate it with interactive brokers. So my goals with the strategy, this is what I'm looking for in a strategy. First of all, of course, is for it to be making money consistently so that it's profitable. I want to minimize my emotional heartache. I want to maximize my return while minimizing risk. I want to try and limit money losing periods, both in size and scale in terms of time period, as much as possible. I want to have some predictability for cash flow. If I have an account where I want to draw some income from it, I would like to have the ability to do that a few times a year at least. Also, I want to be hitting new highs on a regular basis, and I definitely want to be performing better than a benchmark like the S&P 500 or NASDAQ 100. So with those goals in mind, I took a look at a number of different metrics and basically came up with the ones that I can kind of equate to those goals. So things like compounded growth rates would equate to a profitable strategy. What kind of maximum drawdowns am I seeing, which would equate to things like emotional heartache. What the ratio is between the compounded growth to the maximum drawdown, which would be a risk-reward type measurement. I look at something called R-squared, which is the linearity of the equity curve, which gives me an idea of consistency. I look at certain ratios like the Sortino Ratio and the Ulcer Index, which give me an idea of the return I'm getting versus what kind of risk I'm taking. I look at expectancy, which gives me an idea of what kind of cash flow I could generate. New portfolio highs, which for me represents stress reduction. And then things like winning days, months, or years, which again could be equated to things like cash flow or consistency. So what I'll do is I'll just take a look at each of these briefly to give you an idea of how they're calculated and what kind of how they compare to benchmarks and how I look at them in terms of how I evaluate a strategy. So the first one is called the MAR ratio. This was a metric that was put together quite a few years ago. I think it was with some mutual fund reports that had come out. And what these guys did was they looked at the compounded growth of a strategy versus the maximum drawdown that it experienced. So it gives an indication of the kind of performance you can expect versus the worst case scenario, which could be looked at as a risk-adjusted return. And basically by calculating this for different strategies, different benchmarks, you can use it to compare performance between various strategies. And again, the longer the time frame, the more useful it is. And a value greater than 1 is typically very good. So if your growth rate is bigger than your maximum drawdown, then the strategy could be very favorable. To give you an idea of some example values, the two strategies that I have at the bottom here, the TSX NDX strategy and the limit order strategy, are strategies that I'm running currently. And the TSX NDX is basically a portfolio that is a mix of Toronto stocks and US NASDAQ 100 stocks. It's like a monthly rotation type strategy. The limit order strategy is a shorter term, like maximum 4-day hold period, where I use limit orders to enter trades, and it's based on the NASDAQ 100. So if we look at kind of what the various benchmarks and strategies, what the MAR ratio looks like, for the S&P 500, it's about 0.2, as well as the NASDAQ 100. And for the strategies I'm currently running, the MAR ratio is over 1.5. So this gives me a good indication that it's, for the returns I'm getting, I'm not taking too much risk.
Sounds a lot better than buying an index fund.
Yeah, way better. This might be a little hard to see, but what this shows is the maximum drawdowns I experienced one particular strategy. This is going from 1995 to the present day. So you can see like there's periods, for instance, during 2000, 2001, where there was some pretty steep drawdowns. The scale on the left here is 0, 10, 20, all the way to 100%. So worst case here, you're looking at a drawdown of maybe like 22%. And then a lot of other times you're at drawdowns of maybe 18%. So the MAR is basically, this value is in the denominator, so the 22%, and then the compounded growth is in the numerator to get the overall ratio. Now, what you might, if you can see it, this worst case scenario is very isolated. I think it's a single day where it reached that worst case drawdown. So what I might do in some cases is take an average of the 5 worst drawdowns to get a little bit of a more accurate reading, because a single day out of 6,000 days is not really statistically meaningful.
So what do you do on that day? You just wring your hands, or
On that day, you suffer through it.
you just suffer?
Yeah, I mean, the way I approach it is that I've committed myself to the strategy. I have faith in it. I trust it based on the testing I've done. So I'm going to let it run its course. There's always things in place like stop losses or macro indicators I use to get out of the market.
Mm-hmm.
The problem with those indicators is they're lagging, so that by the time this has happened,
It's too late.
it's too late. Like with any investing, right? If you had hindsight, then it would be great, but you don't.
Okay.
So that's my approach: is I trust the strategy and I follow through with it.
So you don't turn this off, you just let it.
Right. A lot of this is back-tested data, so it's theoretical data. It's based on good, accurate information, but it's not real trades,
Yeah.
right? It's all hypothetical.
What's going on?
Yeah, it's guidelines. It's not necessarily what's going to happen in the future, but it gives you an idea of kind of what the worst case scenarios look like.
So that would be like your in-sample data, and now that you're running it, it's all your out-of-sample data.
Right. Yeah. So I've been running these strategies, some of them for 5 years. So I have a lot of out-of-sample data now to go on.
So is most of you trading end of day, or
This is all end of day and on the open. So I generate signals based on end of day data, and then I actually execute the signals the next day. I'll go through a little bit of how I do it. So the next thing I look at is something called Rsquared. This is a measure of equity curve linearity. So basically, ideally you'd have a line straight up and to the right with very little deviations. And this gives you a kind of a benchmark against, how linear that equity curve is in actuality. So I actually look at a log scale of the equity curve because this is based on compounded growth. So the log scale is used to make it a linear curve. And this basically looks at a difference between a straight line and the equity curve, which is also called a linear regression. So a value close to 100% is the best. If we look at kind of the benchmarks versus some strategies that are being used, the S&P and the NASDAQ are in the 85% range. The strategies I mentioned are in like the 97% range.
Sounds better.
Yeah, sounds a lot better. So I included this just to give you an idea of why I use a log scale. So on the left is a compounded growth curve for 3 different growth rates, 10%, 20%, and 30%. Starting with $1,000 over like a 35-year period. So the linear curve you can see is exponential. If we take the logarithm of that, it becomes a linear, becomes a nice line that we can now use to fit a regression line to. So this might be a little hard to see, but basically the darker blue here is the equity curve, and the lighter blue is the regression line. So the R² represents kind of all the differences you see between the line and the actual equity curve. But ideally, you want this to be up and to the right as close to a straight line as possible. Any questions on that?
So can you tell how much deviation you get from the actual line?
Well, you can do like an error value out of this,
Okay.
which represents kind of the sum total of all the errors between the best fit line and the actual curve. You can do this in Excel, where it'll give you, 10 different statistics on the regression.
Okay.
If you look up LINEST, LINEST in Excel, it'll tell you all the different stats you can get on linear regressions.
And the growth rate is the slope. Yeah?
The slope is close to the growth rate. The only difference is going to be that this line has an intercept point on the left side.
Okay.
The intercept point doesn't exactly match the starting point of your equity. So the slope is going to be very close to the compounded growth, but might be a little bit off because the line of best fit doesn't necessarily follow that exact slope. The next thing I look at is called the Sortino Ratio, which can be used to evaluate an investment's return for a given level of bad risk. So it's defined as the average return over the period you're looking at, divided by downside deviation. So any positive months, I use this on a monthly basis, any positive months are zeroed out, and it looks at the volatility of the negative deviations. So if you've ever heard of the Sharpe ratio, this is similar to the Sharpe ratio, except that the Sharpe ratio looks at overall deviation, which includes all the positive months as well, which has the effect of penalizing upside deviation. Whereas I would like to have a lot of upside deviation, right? I want months that are extremely volatile.
I would like some upside deviation too.
Yeah, I want months that are really volatile in the upside direction. So the Sortino ratio gets rid of those and penalizes only the negative months. So to give you an idea of the example values, the S&P and the NASDAQ are in the 1.2 type range. With these other strategies, you're looking at like 4 to 5 times better than that. Another indicator I use for basically downside deviation is something called the Ulcer Index. This measures the depth and duration of drawdowns. And larger drawdowns are given higher weight than smaller drawdowns. So this was created back in 1987 by this guy, Peter Martin, and he created it as an alternative to standard deviation because standard deviation has some drawbacks when used as a measure of risk because it's not affected by the sequence of gains and losses. You can have a terrible strategy, but that comes out with the same standard deviation as a reasonable strategy just because of the way the gains and losses are ordered. The Ulcer Index avoids that problem because it actually keeps track of what the drawdowns are looking like and how long they last and how deep they are. So a lower Ulcer Index indicates a strategy that is very good at avoiding major declines. It's been described as perhaps the most fully realized statistical portrait of risk there is. And you can come up with this thing called the Ulcer Performance Index, which is an alternative to the Sharpe or Sortino ratios, where the Ulcer Index replaces the standard deviation in the denominator of that ratio.
That's the one I like.
The Ulcer Index?
The UPM.
Right, yeah. Yeah, it's a great indicator. So if you're going to take a look at like a drawdown curve versus time, the black line here represents the value that is calculated for the Ulcer Index. So for instance, it gives like a 4-point-something% value, meaning that on average over this entire time frame, it's approximately a 4% downward deviation. Whereas if you're looking at something like the NASDAQ, the average deviation comes up to like 39%. So that can be very stressful, right? That can really cause some ulcers. The next thing I look at is expectancy. So this is, I use this to give an indication of expected profit per trade or over a given time period. So it's defined as win percentage multiplied by the average win size plus the loss percentage times the average loss size. If you look at, now expectancy is calculated typically on a trade by trade basis. But what I do is I normalize this to a monthly time period to a given amount invested. So then I can compare them between different strategies. So so for instance, on the NASDAQ, you can expect to make about $13 per month on $1,000 invested. With some less volatile strategies, you can expect to maybe extract $30 per month. So 3% per month on average. So, I mean, I use this as a way to determine how much cash flow I could generate from a portfolio. I also look at new portfolio highs because I figure that if the strategy is hitting new highs on a fairly regular basis, then I'm going to feel pretty good about it, and I'm probably going to stick with it. Whereas if it's few and far between, then you can probably get a little bit discouraged by it and move on to something different. But typically, what I've found is that anything over about 10% is very good in this situation. The S&P 500 hits new highs about 9% of the time. The NASDAQ is at about 7%. The difference here is that the S&P actually has dividends reinvested. So that gives a little bit of a boost to the returns. With a little bit of tuning on strategies, I can get it up to about 15% of the time hitting new highs. So 1 out of every about 6 to 7 days on average.
So Gary, before you go to the next slide, do you think, I think this is actually really interesting because I don't think we can easily do this in AmiBroker where we see I'm sure Matt's online. Matt probably knows how to, program the custom backtester interface so that, we could calculate the new portfolio highs. But that's actually not something I think a lot of AmiBroker guys look at in terms of like how often it's hitting new highs. And I'm just wondering, like, what are your thoughts on the fact that, do you think this is one of the reasons why it's so difficult to trade? To be honest, like
I think so, yeah.
Because I mean, like, if only 15% of the time your equity's hitting new highs, that means the opposite, like 85% of the time you're underwater.
Yeah.
Right. So,
yeah, I mean, if you look at drawdowns, basically what this is showing is that 85%, the blue areas here are 85% of the time, right? It's only these small areas that it's hitting the top, which account for 15% of the time. So you're in a drawdown situation almost all the time.
okay. So Matt's saying this would be an easy custom metric to create an AmiBroker. So I'm assuming that means it would be easy for him. It would probably take me a couple of weeks. Thanks, Matt.
Yeah, I mean, if you look at there's a paper that comes with the Ulcer Index, because the Ulcer Index uses drawdowns as its calculation. So they have a metric for calculating
Thanks,
new
Matt.
highs. But there's in that document, if you look on the Ulcer Index on the internet, there's a PDF you can download. They give the pseudocode for generating the new high code, the new high
So that's in the Ulcer Index?
Ulcer Index document, yeah. And it's pretty simple. You're basically just keeping track of the new high and then comparing the next value to it until you hit a new one and then you up it, right? So
Can you do it by just monitoring the equity curve?
you can, but you have to, it's like a stair step, right? You've got to basically record the new high, and then until you hit another new high, that's the level you stay at.
It's
And
like
then-
maximum drawdown, where the stair steps
Right.
down.
Exactly, it's the
Only this is
opposite.
the reverse. the
Yeah.
stair step up.
So then each of those steps is a new high. And then from there, you can extract all kinds of information like the percentage of time you're at new highs, the amount of time, average number of days you spend there, what's the average length of a new high, that kind of thing. What's the time between consecutive new highs?
Just for the general interest, when I was going through, I'm going through maximum drawdown. The maximum drawdown formula is buried in the report. That is standard in AmiBroker.
Right.
Right?
Yeah.
So what you're just telling me is reverse that equation so that it's picking up the opposite. In other words,
Right.
the climb rather than the coming down.
Yes. Yeah.
So Jim, you look pretty cheerful for a guy who's going through maximum drawdown.
So that's called maximum withdrawal.
Yeah,
And I was
different.
disappointed we couldn't drink. So. Yeah.
Yeah, so this is a graph of new highs versus time. So it gives you an idea of, periods, difficult periods, where you're in a drawdown situation for a long period of time. So like back in 2011, in this case, and also here in 2015, were some rough patches. The interesting thing is that, this would be a fairly rough period as well, because you hit the new highs, but then you're going back into a drawdown situation right away.
So is the drawdown the black area?
The black area is the drawdown periods, yeah, and the white is where it's going up to the top here as a new high.
Is there any way to statistically predict that?
No, the only thing I've been able to extract out of this is kind of the average time between new highs and the percentage of time that it's hitting new highs.
What is the average time between your highs?
Well, I think you can get it from the percentage. It's like 7 trading days, something like that. For this, it would be 7 or 8 trading days. For the S&P, on average, it would be like 11 trading days, I think.
Between new highs?
Yeah, on average. But
On average.
you can have periods where it's, or where it's hitting new highs every day for like a week straight.
Yeah.
So once a month or twice a month.
I just want to
Yeah.
trade those times of the month.
Yeah, yeah.
The day before.
We lead it up to that.
Yeah,
That's what we've been hoping from you.
yeah.
I'm not hitting maximum drawdown, so I feel okay.
The next thing I look at are winning days, months, and years. So if we look at, typically, the longer the time frame you look at, the more predictable or stable this becomes. But on a day-to-day basis, you're looking at winning days of maybe 55 to 57% of the time that are positive. Whereas months can range anywhere from like 2/3 of the months to 70%, and winning years anywhere from 80 up to 100% of the time are winners, right? Like even for NASDAQ, 83% of the years are winners. It's just that the bad years are really bad.
I like your statistics, 100% winning years.
Yeah. Well,
Nice.
I'm surprised the winning days are that, you're 55%, that's not much better than a coin toss.
No.
Well, that's, I mean, I've read some papers about that it's about 56%. And that 6% is your edge, is that the fact that the market goes up, you know, that 6% more than it goes down.
Yeah.
On average. That's basically your edge. And
Mm-hmm.
whatever you can extract from that, whichever way you can do it.
Yeah, and if you can bump that up a little bit, then the edge gets that much better, right?
Absolutely. But casinos only have a few percent edge in some of the stuff, eh?
Well, I was reading about Jim Simons,
Mm-hmm.
Renaissance Millennium Capital.
Yeah.
Just over 50% of his trades are profitable.
Just over 50.
Yeah. So he has a lot of losing trades, but
he has all the best PhDs in the world.
yeah, it's all the analytical stuff, and he's able to extract profit so much better than, you know, when he cuts his losses.
It's amazing.
That
He's willing to cut the loss because he knows, when I do win, I'm going to win big. And
right.
That's
And he has one
thing
big.
to trading.
Yeah.
That's the whole thing, is just, you know, the old adage, cut your losses and let your profits run.
Yeah.
Or like I used to do, is cut your winners and let your losers run.
And hope.
I know that one.
Well, you know, I want to help put some rich brokers' kids through university, right? So
Yeah.
do my part.
You're trying to figure out how to go on welfare?
So what is risk? Well, one definition is that it's the uncertainty about the outcome. So the less data you have, the more uncertain you have about the outcome. Conversely, the more accurate data you have, the more certain you are about the outcome. So I use this premise to basically come up with strategies and make sure that I have good data to do testing on. So in order for a backtest to be statistically meaningful, there must be enough data points to test a reasonable number of scenarios. Each time you add a parameter to a backtest, the number of recorded data points increases. So if you have an extremely complex strategy, you probably need many decades of accurate historical data to produce a useful backtest. Whereas a simple strategy allows for shorter backtesting or more meaningful results. The strategies that I run incorporate price action for momentum and some kind of macro indicator for a go, no-go situation for either being in the market or exiting the market. So I don't use any complicated indicators. And like we just mentioned, it's really all about probability. Many profitable strategies may only have slightly over 50% winning percentage. So you have to accept the fact that you're going to have a lot of losses, a lot of losing trades. But as long as those losses are cut and the winners are allowed to run, you can definitely come up with a strategy that will have a positive expectancy. And then it's the accumulation of those small winners over time that leads to large profits over time. But that being said, you can have long stretches of winners and losers for any strategy. So you could have a period of 8 to 12 days in a row that are losers, or periods of 11 to 16 winning days in a row. That's just in things I've observed, but I'm sure it's similar for other strategies. So it's very important not to get discouraged over those losing periods, and make sure you stick with the strategy. So
Gary, just before you move on, I just want to get your take on this. So what is your thought? Like I've heard of, and I've experienced this too. Some people talk about the outliers or what actually put you over the edge.
Right.
I remember I was going through a period where I was trading a sort of mechanical strategy, but I was doing it discretionarily.
Yeah.
And you know, my P&L was just kind of hovering around zero. It was a little bit down, a little bit up, a little bit down, a little bit up. Then all of a sudden I had one trade that put my account up 7%.
Right.
Because I was trading options. And it was like that option it was a buyout and it just exploded. It was like one of those, just an outlier.
Yeah.
And it just, You know, like if you can tread water and catch an occasional outlier, you can make money doing that too, right?
Oh yeah, for sure.
Because you're going to catch outliers, like the more opportunities you exploit. But like, have you noticed any of that in your data, that the outliers like push you over the edge, or is it more kind of a steady process for your strategies?
Well, the one thing I included in here was like days over 3% winners, or days that return more than 3%. And the fact that without them, the strategy is barely profitable. So it definitely is those days that don't happen very often, but are huge winners that kind of bring the profits to the next level for sure.
So basically you have martingale, which is what you're describing.
Yeah.
But the outliers take you out of the martingale constraint. You know what I mean by martingale?
Well, it's a
If you flip
betting,
coin
yeah,
constantly, you'll lose,
right.
okay, because of the martingale effect. But if you have big outliers that pop up, then you win.
Right.
Because it's not, you know, you're not just flipping the coin, you're also increasing.
I was thinking, when you said martingale, the first thought that came to my mind was when people keep adding into positions, what do you call that?
Pyramiding, you're doubling.
Yeah, but there's a specific name.
Well, there's,
Averaging in.
Yeah, it's a martingale.
Adding to your losing.
Yeah.
well, there's also Kelly, right? Kelly criterion,
Right,
which is the optimal bets to use.
right.
So that it might be related to that too.
But when you keep doubling down, isn't that called martingale? You keep doubling
That's
down?
reversion to the mean, you know.
Well,
It could be martingale.
The martingale is usually like, I don't know if it's poker or.
Yeah, it's betting.
so that way
Statistically-
when you lose, you double your bet.
Yes, that's what
You
when you
bet to where you win, and you're back to even.
when you said martingale, that's what came to my mind.
Well, the martingale is an effect of if you are 50-50 odds, you will lose. That's the martingale.
Right.
That's been proven statistically. So
Yeah.
you're looking for a bias which gives you more than 50%. And here you've got 7% bias. So
Yeah.
that's taking you away from that martingale. But martingale is the series of losses you build up over time. In other words, you know, it should be 50-50, but it really isn't. It's sort of like runs of 10 winners and then,
Okay.
you know, 15 or 20 losers.
Yeah. Well,
I
the
think-
whole statistical thing can be very, what's the word for it?
Frustrating.
Frustrating, but not intuitive. Because just because something has a 50-50 odds doesn't mean that you can't have 20 heads in a row.
Yeah.
It can happen.
Strings of wins and
Yeah.
losses.
Or
And-
30 losers.
Yeah, and the other thing that,
That's where your expectancy comes in. Because if you have
yeah,
higher expectancy of greater returns,
Yeah.
then they outweigh the martingale effect of you know, those losers that we
Yeah.
build up over time.
yeah, the other thing that's that's counterintuitive is that even if you have 20 heads in a row, the chances of a head or a tail coming up the next time is still 50-50.
Yeah.
It's not affected by there's no prior knowledge, right? So like betting on roulette, because black hasn't come up in a while, you know, betting that black's going to come up is a losing strategy because the chances of black coming up are still 50-50 the next time.
Assuming somebody hasn't fixed it.
What, right?
So just so we get this on the recording, definition of martingale: a gambling system of continually doubling the stakes in the hope of an eventual win that must yield a net profit. So that's, yeah.
It only works if you have an infinite account.
Exactly.
Yeah.
Exactly.
Yeah.
I've seen somebody lose over $300,000 doing this
Yeah.
live
Yeah.
on, like in a webinar.
Yeah, because
I
you,
lost over 300 at blackjack. I also had a large winner doing it too.
yeah. Yeah, so as we mentioned, you can have long strings of losers. So patience is very important. And as I mentioned before, the drawdown situation is that, 90% of the time, 90 or 85% of the time, you're going to be in a drawdown situation. So for instance, with the S&P 500, it'll be in a 5% or greater drawdown situation about half the time. So half the time you're going to be in a 5%, 5% below the most recent high situation. A really good strategy will be in a drawdown greater than 5% situation about a quarter of the time.
So was that a hard thing for you to personally learn, or was it all the data that gave you the confidence to deal with that? Because I know, I talked to a lot of traders over the years, and I think what you're talking about there is what's gets them to keep switching strategies all the time, because the expectation and the reality are so different.
Yeah, they are different for sure.
You don't I think it's like the education business. Like when you come into trading and investing, and you see the education and you start subscribing to things, they're always talking about making money. So you just assume people make money consistently, like a paycheck.
Yeah.
But it's not like that at all, right?
No, not at all. I mean, in terms of, making money out of a strategy, I like to look at it on a monthly basis. So if I have 70% of the months out of the year that are profitable months, that equates to 8 or 9 months. So I look at it as an opportunity 8 or 9 times a year where I can possibly take money out of a portfolio as cash flow. Whereas if you're looking at it from a day-to-day basis, you're going to drive yourself nuts because, a lot of those days are not going to be profitable, and it's going to feel like you're losing. It's going to feel like you're losing day to day, whereas over a longer period of time, you're actually winning.
So the back testing has kind of taught you how to be patient and how to recognize that that you're it's a game of patience
and probability. Yeah. The other thing I found is that, as you know, accurate historical data is very important. A lot more important than a lot of people realize. For instance, if you're doing a strategy based on the NASDAQ 100, if you take the current day index, 100 stocks, and you do a back test on that, it's going to look awesome, right? Because that has a lot of survivorship bias built into it. And it has a lot of, it basically has companies that, 15 years ago may not have existed, are in the index now, which have grown immensely. Or it has companies that went out of business that are no longer there. Or it has companies that were bought out that's not represented as well. So you really need to reconstruct the index, or you need to reconstruct your universe of stocks going back in time as accurately as you can, so that if you take a snapshot back, let's say in the year 2000, the universe of stocks you're looking at is accurate. And what you'll find is that once you do that, your backtest results are not going to look as great.
I've seen that firsthand.
Yeah. And you're going to start to, well, it's good because now you have an accurate test that you can put money behind, right? Versus a test that looks great, but is going to fall apart as soon as you put money behind it.
Well, a funny story about that, Gary, when I automated my first trading system, I at the time didn't have, thank God we have Norgate NDU, right, with AmiBroker, because it does all that for us automatically with a little bit of coding changes and stuff. So I automated my first strategy. I spent, not a small fortune, but I spent a good chunk of money to have a custom system design. But I wasn't using historical index constituents to do, when I first was testing. My results looked pretty good. So then when I went back and tested it, when I got the new data source, I looked at it and I was like, oh, this doesn't look as good as it used to. It still had an edge.
Yeah. And
it was still net profitable, but I'm not sure if I would have made the decision to automate it based on the revised results using the proper data.
Yeah.
So, I've experienced that firsthand. It's super important.
Yeah.
The way I explain it is, it's as if you knew what the NASDAQ 100 is going to be in 10 or 20 years, all you have to do is look at those stocks and buy them today,
Right.
and they'll be good.
Yeah.
Yeah.
If you're a time traveler, you can do that, right?
But that's what you're doing if you don't use proper indices.
Absolutely.
Exactly. Yeah.
So what period are you from? 2021?
I'm from the Paleolithic era.
Oh, you're moving forward.
Yeah. That doesn't help us.
Doesn't work.
Yeah. Okay. So, yeah, paying attention to the losses. This is more of an emotional thing where if you look at a back test and the equity curve looks really good and you've done your analysis and all the metrics look great, the problem is that when you're actually really trading it, it's the drawdown periods and everything that become really difficult. And it's at those points in time where you're starting to question, like, is this thing still working? Am I just going to keep losing money?
Why was I born?
Yeah,
do this to myself?
yeah. This is depressing. So, I mean, you really have to maintain faith in the strategy, and it is about risk management. So if there are difficult drawdown situations, you have to have a way to basically limit those and, some way to get out of the market or minimize risks and smooth out the drawdowns, reduce the stress, and make sure that
That's next month.
it's an evolution, right?
Now I have a presentation on that.
Oh, okay, yeah.
That'll be good. That's a
Yeah.
good segue.
The other thing I've found is that doing more transactions is not always bad. I've been running a short-term strategy, which is like a 4-day turnaround strategy, and also a monthly rotation strategy. The shorter-term strategy actually outperforms the longer-term strategy.
Even with commissions.
Yeah, and with I use interactive brokers, and with IB, I can do a trade, especially with larger companies. Like the average stock on the NASDAQ 100 right now is, I think, $190 per share. So at IB, you can buy 200 shares for $1. So, you can buy almost 40 grand worth of stock for $1. So I'm not concerned about commissions. And with specific trading methods, you can really reduce or eliminate slippage as well. So as long as you can keep those costs down, then doing more transactions is not going to be, is not really a bad thing. You can do it. And just a point about active strategies versus buy and hold. As I mentioned, I use different indicators like moving averages to basically determine whether I want to be out of stocks or invested in stocks. So that way I can be out of the market during difficult periods. Of course, there's always a trade-off. It's going to miss out probably on the next uptrend a little bit. The next recovery, it's not going to get in right away. But I would rather avoid a large drawdown and have that as a trade-off. Right? I mean, if you look at buy and hold performance, it can be awful, right? I mean, the NASDAQ back in 2001 or 2002, the low it hit was 83% drawdown.
That's huge.
From the peak in like end of 2000. And it was in that drawdown for 15 years.
Yeah, that's right. It was.
Yeah, it was brutal. Yeah. So, I mean, that's what a buy and hold situation can give you, right? Whereas with active strategies, where you're out of the market sometimes, you can limit the drawdown periods to maybe just over a year. And you can limit the drawdowns to, instead of 50 to 80%, to maybe 30%, which sounds a lot better to me.
Yeah, absolutely.
Typically, how many stocks do you hold in one time?
In the
Because that's your other parameter in this? Is
Yeah, so
diversifying the stock mix.
the short-term one, I have 5 positions.
Okay.
The longer-term one, I have 6.
So you're pretty concentrated.
Yes, very concentrated.
See, this is, these stats that you showed here is why most investors that are really good are old, because you need time, like Warren Buffett,
Right.
right? If you can live and keep investing into your 80s, then, you know, you can hold through these periods and come out on top.
Right. The other thing is many things are counterintuitive. So, you know, things like the US-China trade war, all kinds of people talking about recession, Trump winning the election, you know, and at the same time you have markets hitting new all-time highs on a regular basis. Other things like, you know, I use momentum strategies where I look at basically the top performers over the last 6 months. And in my testing and my experience, these perform better than value strategies.
It's the momentum effect, right?
Right. And then, like you mentioned, having a very concentrated portfolio, which can be pretty volatile sometimes, on a day-to-day basis, the overall volatility on the portfolio is actually lower because of the nature of the profit over time and the returns over time.
So wait a second, so you're saying overall portfolio volatility can be reduced by buying volatile stocks?
Yeah.
That is very counterintuitive.
Yeah. What I'm not saying that it's going to be less volatile on a day-to-day basis.
Right.
What I'm saying is that if you look at a monthly or yearly time frame,
Right.
the volatility on that will be lower.
Okay. Oh, that's wow.
That is an odd one, yeah.
And yeah, like listening to like talking heads on CNBC and paying attention, like, you know, posts on StockTwits can definitely be detrimental to portfolio performance. And in my experience, gut instincts are almost always detrimental to making money. So that's why I like to use strategies, because if the strategies are telling me to do something based on very objective rules, then I'll just follow the strategy.
So
I have one question.
Yeah.
Which is my curiosity. A lot of strategies are built around the Fed incentive. You're telling me that not so much.
On the what? The Fed?
Fed incentive.
So I was going to ask about that too.
Oh yeah, I don't pay any attention to it.
So I think basically, so what you're saying is events like earnings, inverted yield curve, and the Fed. So basically, you can ignore all the earnings announcements, just let your strategy run all the time.
Right. I understand that sometimes I'm going to have a gap down. Like I've had stocks, you know, gap down 25% in a day. So.
Can you just stick it?
And I won't sell it that day. I'll sell it the next day, even though it's difficult. But basically, all the stuff I do is based on the closing prices. So if a stock gaps down, then I let it play out for that day, and then if it's below my stop, the next day I'll sell it. But I will always hold things through earnings. And because of what I found is that earnings can also be very positive.
So it balances out.
Yeah, and in general, I think I've had more positive things from earnings versus negative things from earnings.
That would be an interesting statistical
study,
to see, like, holding through earnings. If you were to trade all the earnings, would you be net positive or net negative?
Yeah, the difficulty I had with that was that I found some sources, but I could never find really good sources of earnings information.
Yeah.
Like going back 10 or 15 years.
Yeah.
So if you guys know of one.
Do you guys know if Norgate, I've actually not even looked into it. Do we get earnings data through Norgate?
I did.
You get all the dates and stuff?
Yeah, it calculates that into your whatever strategy. You can check it off that you want all the earnings, you know, and you can see the difference, you know, about 3% a year or something on your returns if you include the earnings.
Okay. Matt's saying he thinks only dividend dates, not earnings dates. But you know what? Well, let's look into that.
Oh, earnings and I should say it's it's, earnings is something different from dividends, isn't?
Yeah, like the
Yeah, quarterly earnings, you know, where they announce for the past quarter.
No, yeah. No, I was thinking dividends, whether to add that into your
Yeah.
returns.
Yeah,
Yeah.
so Matt, that's what Matt's saying. He thinks only the dividend dates, not the earnings dates.
Yeah.
So
Yeah.
we should look into that. I wonder if like maybe Quandle or somebody
I
has.
think like Y charts might have it.
Okay,
I think it's a paid service though.
because it'd be nice to have that data.
Yeah, I mean, you could backtest it. It wouldn't be that hard.
You have in,
'Cause
I
it's-
think Portfolio 123, it's an online
Yep. Yeah.
service. You can get stuff like that, like fundamental data.
Right.
And you can put that into your strategies.
You know, if we had more data, there's so many interesting things we could do with all this new alternative data that's coming out.
Yeah, I mean,
Thanks, Matt.
if possible, I do the dividend adjustments because it gives you a truer idea of the price curve of a stock if you include the dividend adjustments.
There was one company that used to specialize in forecasting earnings. I can't remember. It started with Z.
Oh yeah,
Is that
I'm not sure.
ring a bell? Anyway,
Zacks.
Zacks. Yeah.
Oh yeah, okay, yeah.
And-
Zacks
and
Research,
They would publish information on expected earnings gaps,
Right,
where they expected certain guys to do better than what they had forecasted.
right.
And,
Yeah.
that's
So-
Yeah, you can use option data as well to do it, but
Sergey had an interesting take on that at the last meeting. He, I don't want to digress from this too much, but just in a nutshell, he does options plays based on what the expected move is for an event and what he expects it's going to happen, and he looks at some of the back data and he kind of puts it together so that he can find an edge because he believes it's going to move more than what the market makers think the expected move is. So I wish we recorded that. Actually, I would have liked to rewatch it.
Just watch The Big Short.
You know, maybe what we'll do is we'll ask
Yeah.
Sergey to come in here sometime and do a presentation on his stuff because I don't think you guys know him. But anyways, sorry, I don't want to.
That was The
We'll
Big Short,
try-
by the way.
Sorry.
That was The Big Short.
Yeah.
Guys expected the mortgages to fall out of the sky.
Yeah.
Never happened, and then all of a sudden it happened.
yeah, they had to wait a while. Indicators need to be tested. So as you know, there's all kinds of different indicators out there, and ones that, you know, purport to offer an edge. But in my experience, they really need to be tested. So if you do want to include indicators into a strategy, you really need to test it properly.
So sorry to interrupt you again, Gary. Just a quick question. So Graham is asking, he says, thanks, Gary. What is the % exposure of your strategies to market? Like, are you invested 80% of the time or?
It depends. The shorter term one, I think it's out of the market. I think about half the time it's out of the market.
So your exposure is about 50%?
I think about 50%, yeah.
Okay.
It's based on a sentiment indicator from the Commitment of Traders report. So it's based on, so there will be periods where stocks are out of favor and it'll either just go to cash or it'll go to maybe like a bond fund or something like that.
So that's one of your macro sort of indicators.
Yeah. And then for the other
Market
strategy,
regime filter, whatever.
yeah, for the other monthly rotation strategy, I use a moving average on the SPX. That one is in the market more. I would say it's probably in the market 80 to 90% of the time.
So what do you? This brings up an interesting question. So, your shorter term strategy is 50% exposure, and your longer term strategy is about 80% exposure.
I think so, yeah.
So what do you think is a better market regime filter, a moving average or a sentiment kind of based indicator? Or is it just?
It depends, because I found that the one shorter term strategy worked better with the sentiment.
So it
sentiment
could
type
be based on
indicator.
the time frame of the actual strategy.
Yeah, I tested them both back to like 1995, so it was a
Okay.
very long back test.
So one just happened to be better for one strategy and
Yeah.
one for the other.
Yeah.
Okay.
And for the monthly rotation, because I'm not doing that many trades, that's another reason why it's in the market more. Because it's only going to be out of the market if I got to stop for one of the positions, or if the moving average gets breached. And the breach of the moving average doesn't happen very often.
Okay.
Because it's like a 200-day or something longer term average.
Mm-hmm.
So the breach of that doesn't happen very often.
Makes sense.
That's a pull the plug on everything at that point.
Right. Yeah. I just sell every position and wait it out. It works okay, but like I said, the trade-off is it doesn't get back in until, the following month or the month after that.
You missed the
And
recovery.
there could have been a nice recovery. Like this year, for instance,
that, eh?
this year, the results on that monthly rotation for the US market haven't been as good because it stopped out in, I think it was February. There was a big downdraft in February, and then I got stopped out, and then I don't think it came back in until April. So it missed the kind of the March upwards, right?
Mm-hmm.
But I'll take the good with the bad because, if you have other strategies that are working well, then it kind of offsets it.
Yeah, I guess that fights your need to be active too, right?
Right.
Because if you're running one strategy and you're not in the market, you're getting the FOMO.
You get
going
antsy,
on.
yeah. I'll skip over that. Okay, so combining strategies. So like I mentioned, I run a monthly rotation type strategy. So what I do is I combine it as a single portfolio of Toronto stocks and NASDAQ 100 stocks. And I split it as a 45-55% split. The reason I do that is because I wanted more in the US, just because it's a larger market. Plus I did some testing, and this was a good split to have. And then once a month, I take a look at the portfolio balance between the two of them. And if it's out of balance, then I make an adjustment. But I only do like a 1.5% adjustment from one side to the other. So I'll move cash from the US side to the Canadian side, or from the Canadian side to the US side. Well, I do it on IB, and it costs $2 to do a currency, like a Forex transaction. The way I look at it is, if I'm doing it on a monthly basis, the currency is going to average out over time. Plus, I'm also factoring that in because when I look at the portfolio sizes, I'm looking at them in Canadian dollars. So if the exchange rate has gone up a lot, then the US percentage is going to be skewed upwards. So I'll end up moving more to the Canadian side. So I'm taking advantage of the exchange rate anyway, right?
It's important to keep the Canadian perspective.
Yes. Yeah. So I look at everything in terms of Canadian dollars for portfolio value, but I keep the portfolio in US dollars on the US side.
Makes sense, because ultimately that's where you're going to be spending it, right?
Right. Yeah.
Unless you decide to move to the States.
Right. But like, at Interactive Brokers, it's very easy to have US currency and Canadian currency. Yeah.
There are no Canadian brokers that I can find that didn't charge you like 1% to 3% every time you switch from one. That's crazy. You just can't do it to switch from one currency.
Yeah. I mean, I use CIBC, but when I do a currency conversion there, I use the DLR ETF. If you guys are familiar with that.
What's that maneuver called? You were telling me about that. I wrote it down.
Yeah, what is that called again?
It's when you journal it over.
Yeah, what you do is, who's the ETF guy? ETF company, Horizons. Horizons has an ETF called the DLR, and they have it listed both in Canadian and US dollars. There's like a DLR and a DLR.U. So you can buy it on either side, So if you want to go from US to Canadian, you buy the DLR.U. And it's priced in US dollars. And then you have to wait, though. You have to wait 2 days for the settlement. Then once it's settled, you journal it over to your Canadian side, and then you sell it in Canadian dollars. So the only fee involved is the split, the bid-ask split or spread, which is very tight usually. It's like a penny or something. And then there's the commission on either side.
So the value of one versus the other is just the difference in the exchange rate?
Yeah, like right now, it's
No spread?
I think the US one is priced near $10, and then the Canadian one right now would be at like $13.30, right?
So you're just taking an offset to your stock holdings or?
No, I'm just buying it as an ETF. Like if I want to move money from one currency to the other and avoid the 2% fee that the bank charges. Because if you're moving $10,000, that's $200, right? I'd rather pay $20 in commission and split and spread versus $200.
Yeah.
So you buy the ETF and then you journal it over and sell it on the other side.
Do you have to call them to journal it over?
With CIBC, you do it. Maybe not with other brokers, but I haven't tried. Like I have a Questrade account as well, but I haven't tried that maneuver.
Right.
I think it wasn't play with Questrade, but I think Questrade, you get the one conversion, and when it goes over to the US side, when it stays there, then you want to bring it back, then you have to do something. But then if it's on the US side, you can trade with it,
Right.
and then just.
I haven't tried any US stuff with Questrade yet. And I know they charge like a 2% fee to do a direct currency conversion.
Scotia iTrade up until a year ago used to be free to switch from one currency to another, but they took that away.
Yeah.
Because they realize there's too much.
There's too much profit in it. Like it's,
Oh, yeah, that's the bank.
that's a huge fee.
Oh, yeah, let me-
Most people don't realize it even.
No, they don't. But yeah, if you're looking at doing a currency conversion, take a look at DLR.
I can,
Yeah,
Norbert's Gambit,
Norbert's
yeah.
Gambit.
Yeah.
Thank you. Thanks so much.
You can do it with stock that trades on the New York Stock Exchange that Toronto.
Yeah, you can,
Bank, for example.
you could
Right.
buy BlackBerry or whatever.
I know Brooke Thackeray, who's going to be speaking at the next CSTA. He talks about it, or he has talked about it at past meetings, presentations. He just calls it, you just journal it over, and I can't remember which is the one that he was using. But he's talked about it a few times.
Yeah, any broker can journal over shares that are commonly listed. Like
Yeah,
multiple exchanges.
I should actually use the broker to do this, but because when I have US dollars and I want to convert them into Canadian dollars, I use like OFX, which used to be called Canadian Forex. And basically what you do is you either wire them the money, or I used to be able to just go to my bank and they would do like a debit memo, credit memo
Yeah,
situation, and they put it in their bank account. Then a couple of days later, they would just put the Canadian in my
right.
account for the price that we agreed on at the date when it was converted. And I mean, you can save on like $10,000. You can save up to $300 sometimes doing that instead of going to the
The
bank.
easiest I find.
So IB is probably
we live
better.
on the American border, so half my spending is in the US. And so I use a credit card called BRIM, B-R-I-M,
Mhm.
and they charge no currency exchange. It's zero.
Oh, okay.
That's
So you
unusual.
can, yeah, it's whatever the exchange rate is, you look in the open market, that's all they charge. And there's only that and another one in Canada, I think that does that.
You know, we've
It's
got,
called Brent. You should, if you buy on eBay USA or anything, you know.
We're getting pretty far off track.
we're getting pretty far off track, guys.
Yeah.
Sorry,
Yeah.
sorry, you guys out there. Because sometimes we forget you're out there in internet land. Sorry, guys.
Okay, but it was related to currency conversions. So, and I do that on a monthly basis. So it is related a little bit.
Somewhat.
So, yeah, so what I found was that by,
At Christmas time.
yes, when I combine strategies, the performance actually goes up quite a bit, surprisingly. And I think it's because I'm combining two markets that aren't very correlated. You know, you're dealing with a Toronto market that's energy and materials and not much else. And then you're dealing with like a NASDAQ, which is technology and pharmaceuticals. So by doing this, I was able to lower drawdowns and improve the metrics quite a bit.
So we talk about strategy diversification. This is not only strategy diversification, but market diversification too. So it's
Right.
That's interesting. I have to think about that.
So yeah, if this is what this is the Canadian-US split I've had over the last 20 years. And so what it shows is that, you know, because I'm only doing a 1.5% transfer each month, things get out of balance sometimes. You know, back in, this is like year 2000, yeah, 2000, where the US market was going like gangbusters. The Toronto market was lagging big time. But it's going to balance out over the next few months as I move money, for one thing, but also as the markets start to perform differently. So the Toronto market starts to catch up. And then, you know, by this date here, which is middle of 2002, the Toronto market's now outperforming the US market. So you end up getting swings back and forth between the two portfolios. But over time, they land around this 45% level. And if we look at the comparison of the different metrics, for instance, max drawdown on the individual portfolios was like in the 30% range. When I combine the portfolios, the max drawdown is now 23%. So I'm getting like about almost a 9% advantage by doing the combination. And these numbers are current as of like end of last week. So current drawdown on these was about 5 to 6%. The current drawdown on the combined portfolio, it was almost at a new high. The same with new portfolio highs, where it was, these are running at, 9 to 13%. The combined portfolio is running at almost 15%. And the compounded growth also is better. So every metric I looked at improves when I combine the two together, which I thought was really interesting.
You're getting an offset and a compound. In other words, because you're 50% in the market on one strategy, it may be active over in the other market, but not in the same.
Right. Yeah. Yeah. So this is what I do right now is I run a combined portfolio between the two. I think it's 6 positions in Toronto and 5 in on the NASDAQ. And then this is a monthly rotation. So at the end of the month, I look at the next, top 5 or 6 symbols. And then at that point, I look at the portfolios and then rebalance and then do the new buys.
What do you use for your Canadian data, Gary?
It's all Yahoo data.
Okay.
Except for the historical. The historical is Norgate, but for like delisted and
For your Canadian stuff?
for the Canadian, no, for the Canadian it's Yahoo.
Yeah.
Yeah.
Okay.
And
Because I don't think Norgate supports.
no, that's the reason I didn't subscribe to it was because they have U.S. and Australian,
Yes.
but no Canadian. If they had the Canadian, I would have bought it.
Yeah, I wish they had it.
Metastock has Canadian. I think it's a little bit better than Yahoo.
Yeah.
Yahoo, I've seen errors.
Yahoo, there's errors, but I've been running it for quite a while. And so I kind of know the data now. So any discrepancies I'm able to kind of take care of with little patches and stuff that I've developed.
So question from Wayne. TSX, are you using TSX 60?
I use the TSX, the composite, so the 300. And then what I do is I add some stocks each year from a watch list that I develop. The watch list is based on some newsletters that I subscribe to, as well as there's a venture list that comes out every year, the Venture 50, I think it is. So I look at any of the larger companies from the Venture 50, and I add those to my watch list. And then basically monthly, I do a scan on the whole watch list to come out with the top 10 or whatever, and then those are the ones that
I'm not even really that familiar with the Canadian data, but is the venture for the Vancouver?
Well, it's not really Vancouver anymore. It's just called the Venture Exchange. It's part of TMX now, part of the TMX group.
So
Typically smaller cap companies,
Okay.
but not all are small. I mean, some of them are a few $1 billion, right?
Okay.
Market cap. So they're liquid enough to actually, get a half decent trade. The Toronto market is more difficult to trade though, for sure.
Okay.
The NASDAQ is very easy because everything is so liquid.
Mhm.
Oh yeah, this is what I mentioned before about, if you removed all the days that were greater than or equal to 3%, on a hypothetical portfolio, let's say, the compounded growth went down from 40% to 7.5%.
Huge.
And the days are randomly, there's no way of predicting when this kind of stuff's going to happen. And if you look at the data, what this is showing is the year versus the number of days where the return was greater than 3%. What you'll find is that there was a lot of them back in like around year 2000. Lately, there hasn't been a whole lot, just because the market hasn't been very volatile at all, right? It hasn't been moving much.
I've seen where the returns in that 2000 to 08, 09 period are better using some strategies, and then you get into the current one, and then they just seem to fall off.
Right. So I've
So
seen.
this is telling me why.
I've seen the same thing. Like the returns, like you mentioned, back around the year 2000 were really, really good.
It's still good up until about 2001.
Right. But, I've seen very good years lately, just not to the extremes that we had back then. But I figure if I can get something that gives me 20% per year, I'm really happy.
It's really good.
Yeah. So I just want something that is consistent and, has some kind of edge to it. This here is the month of the year that has the most, or the number of days for a given month. So in this particular strategy, April had the most days that were greater than 3%. And these are the returns by year. So like you mentioned, the returns back here were definitely better. But you're still getting some years lately that have been very good. And this is day of month versus number of days. So according to this, the second of the month has been the best for this particular strategy.
Is this based on the strategy or the number of like the days that have 3%?
The strategy having days greater than 3%.
Strategy having days. Okay.
Yeah. So for this particular strategy, the second day of the month has been the best.
Very interesting.
Oh yeah, maintaining a trading journal or trade log. Do you guys do this? Do you maintain any type of journal or anything? Yeah.
So, or no, actually Google Sheets.
Right.
Because Google has stock data.
Yep.
You can get it into Excel, but it's difficult, a lot easier with Google Sheets, even though it's clunkier to work with, it's slower, but
Right.
it has the Yahoo data or whatever.
Right.
Google Finance data.
Yeah. Okay.
I did this when I discretionary traded. Since I've gone systematic, I don't bother.
Well, I find that recording trades can be helpful, and maybe even recording a reason why you made a certain trade. The other reason I do this is because for tax filing, if I have a nice log of exactly what was bought throughout the year, bought and sold, it makes it very easy to do things from a tax perspective.
Well, if an interactive broker just sends it to.
Yeah. Yeah, they give you that yearly summary, right?
It goes right to my tax number.
Yeah, and just various things related to journaling, to make you accountable for trades. You can look back in time at what you were doing at that point in time, maybe how you were feeling emotionally at that time, how things were going. You can also use it to maybe stop being so impulsive with trades and be a little more strategic.
Do you find this is still important now that you're doing things systematically?
I don't do the journal as much with the systematic stuff, like you mentioned, but I definitely do a log of trades, just so I have a running log of, so I can track profit, expectancy, all that kind of stuff in real time.
Do your systems record that as well automatically?
Well, I have everything in the back test, but the problem is the data sometimes changes, right?
Mm-hmm.
So I don't like to rely on it.
So you want to capture it in real time?
Yeah, plus
Yeah.
the fills can be a little bit different sometimes. Actually, the real life fills can be better than the back test fills if you're using limit orders. Because if something gaps down in the morning, you might get like the lowest of the day or something, right? Way below your limit price. Whereas the back test may only see, it may capture it at the price that you set the limit order for, right? Okay, so use of automation. So I'm using automation right now for the shorter term strategy, the 4-day holding period. And I really like using it because it really takes the emotions out of the trades. If I can give instructions to some type of automation tool, then I know that those trades are going to be executed, and I don't have to be sitting in front of a screen, trying to get a slightly better price or waiting and
Is it sending like market on open orders or something like that?
Yeah, I'll talk about what I do. Yeah. So yeah, if you have a system that uses objective, well-defined rules, you can usually automate that. If you're having trouble automating a system, it's probably because the rules are too subjective. They're like, if the Fibonacci retracement is whatever, and there's no way to quantify it, right? So if you can't really quantify the system, then it's going to be hard to automate. But it definitely frees up time, and it allows for, you can pretty much match up your back test with the actual trades almost 100% if you're doing certain types of trade execution.
Market on close, market on open.
Like, yeah, market on open, close orders. Okay, so this is how I automate my short-term strategy. So I take end-of-day data. Right now I'm grabbing it from Yahoo Finance after 7 p.m. I have a backup for Yahoo, but Yahoo's been working fine, so I'm using it at the moment. But I'm just thinking at some point it might just shut down, like it did a couple of years ago when, who was it? Who bought?
Somebody bought.
Verizon bought Yahoo, I think. And it was completely screwed up for months. But then it came back and it's been good since then. So then the backtest software runs on that current data and it calculates new trades. The backtest software generates a signal file, and then it creates the signal file for the automation platform, which is Alara. So I'm using Alara Portfolio Manager to do the actual trade execution. And then Alara is scheduled to run at 9 in the morning and 9:30 in the morning to place the trades. Now, this strategy, I have a lot of re-entries on this strategy. So I'll actually sell something in the morning, but I have a limit order on the same stock to re-enter it on the same day. So I have to run the strategy twice in order to do that. So what happens a lot of the time is there'll be a gap up in the morning. It'll sell at the gap up, and then the price will come down and it'll buy later on at the lower price. So it can work well. Of course, it can work the opposite way too, where it gaps down in the morning and it sells. But if it keeps going up, it'll never fill with the limit order. But if it comes down at all, it could get filled again, right?
So your limit order will be in place all day long until the close?
Yeah, so I have a limit order below the previous close by a certain amount. That gets put into Alera as a limit order. The sell orders are all market on open orders. So it puts in a market on open order, sells them immediately at the open, right at 9:30, at whatever.
Does that work with the Canadian market okay?
I don't do it with the Canadian market. This is only for my short-term U.S.
This requires high.
This needs a very liquid market.
You wouldn't automate with the Canadian market then?
I don't think so, no. The other thing is I'm only doing trades once a month with that, the other ones, so I don't really need it that much. This one, it's doing, well, it can do up to 5 trades or 10 trades a day, like 5 sells, 5 buys. But usually it's doing maybe 4 or 5 trades a day. And then on average, it might do 25 trades per month on average, because sometimes it's out of the market, right?
The Yahoo data, do you have to like download it each day yourself or whatever? Remember we were talking at the start about using AutoIt to download your data?
Yeah, I wrote a little program to get the data.
Okay, it does it by itself.
Yeah, and then I just have it scheduled to run at like 8 o'clock at night or whatever.
And AmiBroker actually downloads the end of the day during, it uses the closing time as the end of day data constantly on that.
Or you can automate AmiBroker?
AmiBroker is, you just have to send it to frequency of download, if I recall.
And Gary, are you equal weighting most of your stuff for your positions?
It's all equal weighted.
All
Yeah.
equal weighted.
Yeah.
Cool.
Well, I can show you so it might be a little hard to see, but this is the Alera portfolio manager. So there's a place or a screen for setting up your account. So this is, where you set up your IB account ID. They will give you a token based on your license. And then you can set up email notifications for it. The data provider here, this is just for price quotes during the day. Like if you have a portfolio that you're monitoring, it gives you up-to-date pricing through Yahoo Finance. So once you have an account configured, then you go and you set up your strategies. This strategy uses a local file. So basically what it does is it looks in a particular folder for a signal file. And then if it sees a signal file, then it just executes those trade signals. And the signal file, all it is so a bunch of very basic commands. Close, this one's closing charter, market on open. This one's closing AMD at a limit order. And then you have a buy to open on Qualcomm, 20% of the portfolio at a specific limit price. So the Alera software is going to take this signal file and it's going to actually send those trades to Interactive Brokers.
At the specific time.
Right. So this scheduler here, it's a little bit cryptic, but basically it's telling this guy to run at 9 o'clock in the morning and at 9:30.
So you don't inform the market until you're ready to trade. That's what this does.
Right. So sometime before the market open, like in this case at 9 o'clock, it sends the initial signals to IB, all the close signals and all of the buy signals where I'm not in a position, already in a position. If I'm already in a position, Alera doesn't allow me to have the same symbol in a signal file, so I need to run 2 separate passes. So it'll run a pass with all the close signals, then 10 seconds later, it'll run the open ones, the buy ones. So the thing I really like about this is that you can set up your allocation right in the signal file, so that if I want 5 positions, I can just tell it I want 20% of the portfolio, and I don't have to worry about calculating how many shares. I don't have to worry about looking at how much equity I have. It does it all for you, right? Because one of the hardest things that I find anyway about trading manually is figuring out, how much equity you have, how many shares, all that stuff.
Mental math while you're trying to execute. a
Yeah,
trade.
and I just think it's much better to have that done with a computer. And then, so any questions on that?
That's the same layer that you use? in
Yes.
Okay.
Yeah.
And is it something similar? You would use something like that, or is this?
Yeah, my command file looks different. So what I did, because I recently put a course together on how to integrate AmiBroker with Alera.
Yeah.
Gary's using his own proprietary software that he wrote in C. Because you could use any software to interface with it.
Like Alera is a third-party software?
Yes.
Or something that,
Yeah,
like a
so-
specific company or something that?
Yes.
Yeah.
So, I mean,
Yeah.
okay,
So
you're both using the same Alera?
yeah, we use the
software.
same automation sort of execution engine, which is Alera Portfolio Manager that you see there.
Yeah.
And I recently did a course. It's on AmiBroker courses that you can. Sorry for the shameless plug out there, guys. But you can there's some integration scripts, and you can see it will order the integration script in a certain way, so that it'll output it in a standard format.
Yeah.
So my integration script doesn't look exactly like this, but you can output anything from AmiBroker depending on how you want it. Like you could send the command buy to open, the stock name, 20% percentage portfolio, limit price. So it just depends on how you sort of interface it with the how you want to execute the orders. So it's a little bit different. But you have the flexibility to basically do whatever you want, right?
Yeah, it's a text file that they're looking for in that folder, and if it's there, it executes it. It's very simple.
Barry, why did you ever look at using AmiBroker? Why did you write your own software? Or you just...
Well, I hadn't even heard of AmiBroker up until maybe a year ago, something like that. And I had been working on this stuff for quite a while. I had been trying various software, but the thing was, there was always something missing.
Yeah.
So
did you have a close look at AmiBroker? Do you think it would do what you're doing?
I think it would do it. Yeah, I mean,
It's pretty robust.
yeah, I mean, I don't see why you couldn't. I mean,
So for some perspective, Gary's an electrical engineer, so he can do all kinds of wild shit.
Plus, I like writing software, so it was kind of a project for me to do it, and then I got it to the point where it was working really well, and then I just keep adding on to it if I need to, right? If I find an indicator I want to incorporate, or a market that I want to start looking at, or different types of strategy. I guess.
Do you make charts or anything with your software, or is it all just data?
He showed us his software one time, and it's pretty wild.
Yeah.
Like it does all kinds of stuff.
I mean, I generate reports from the backtest engine, which is an Excel. It's an Excel file. So that's what I use for charting and everything, is basically Excel. Most of the stuff is console applications. Like there's no user interface or anything. It's text files.
It outputs some wild stuff.
Yeah.
The other thing you have to watch too is in your backtesting for limit orders, depending on your setup there. But say if you have you're running 5 positions, but you might have say tomorrow morning it calls for 10 setups, and so you can't put out 10 limit orders. You got to pick out top 5 of them, or
right.
And did those, but if you backtest it, it might look at only 5 of those 10 got placed, and so those are your 5 orders. But that's not
in reality. It doesn't happen.
Yeah, in the AmiBroker course, Matt actually rewrote a script for me that takes care of that issue.
Yeah.
It's a limit order script. And
Yeah,
we'll take care of
it's a
that.
custom backtest.
Yeah, using the custom backtester. Sorry, Gary.
Yeah, so I did have
It's
to,
complicated to
Yeah,
really
it
set
is.
up and do it properly for
Yeah.
backtesting.
so I did run into that problem because I was looking at the results were awesome.
Yeah.
And I'm thinking that there's got to be something wrong with this because, and then I realized, oh, it's cherry picking.
That's another lesson, right? When
Yeah.
you have awesome results
Yeah.
in your backtest, it's like, okay, something's
So
wrong.
did you have to adjust for that in your backtesting then?
Well, what I ended up having to do is I had to make it mimic the real market, like what would really happen. And what really happens is, like you said, you can only put out orders for up to 5 limit orders, right? Otherwise,
Unless you had a margin account or something. You could put
right.
10 of them.
Yeah, that's a different type of strategy. But in the case of just limiting it to 5 positions, I needed to limit the backtest engine to maximum 5 so that only up to 5 would ever get filled, right? And that they
And
were
unless you choose
legitimate.
the top 5.
And it's got to be legitimate fills because otherwise you're cherry picking, right?
Yeah.
And as soon as you get cherry picking data in your backtest, the results look awesome.
Oh yeah, it's always a sharp.
Yeah, because as soon as it's like grabbing, it could be just grabbing, maybe you made a mistake and you're looking at the next day instead of the current day. It's grabbing future data, right?
Yeah.
The results are awesome.
Yeah.
But yeah, there's all these little things you have to deal with backtesting that you don't really think about when you're really trading, but you realize when you're doing a backtest that a lot of this stuff you can't do in reality. The other way that I test this stuff is I basically, I make sure that all the trades that it's giving me are the real trades that are being executed. So if I ever find a discrepancy, I know I have a problem somewhere. Which I think I talked about in the next slide. Don't worry, I'm almost done.
No, it's okay.
Yeah, so some of the challenges I've come across with actual trading versus the backtest results. So one, of course, is slippage, especially with small caps. I've run into this a lot on the Toronto market where, if you're dealing with a company with a small market cap with fairly minimal trading volume, you may have to wait a while to get it filled. So it can disrupt your trading plan. But in general, I find that you can get a half decent fill as long as you have some patience. But this whole slippage thing in that can really be eliminated by, like I said, using limit orders and using the market on open, market on close orders. The other problem I ran into was the price data. Sometimes you may have pricing that's a little bit funky in in the downloaded data. So for instance, you might have a price like this, where you have multiple decimal points because of rounding error, let's say. I had this in a real situation where I had a limit price in at 147.77 and the low of the day was 147.77. But the low of the day in the historical data was 147.770004. So in the back test, it didn't actually register as a trade because it didn't actually hit the limit. Whereas in my real trading account, it actually placed the trade. I got filled at 147.77. Very, very little. It doesn't happen. Very rare. But the lesson here was that I have to basically round the pricing in the backtesting engine to have it behave properly, right? So it's just as you start trading, start doing real trades, you find these little discrepancies. The other thing I ran into was dividends.
Can I ask you a question?
Yeah.
What kind of slippage assumption do you use for that?
Well, the goal I use is I like to keep it to 2% for the year.
That's slippage for the whole year?
For the whole year, 2%.
2%.
Yeah.
So you would not make you would make a very minor adjustment for slippage.
So yeah. So for instance, I have an example here. For the short-term strategy, on average, I make 325 trades per year. And if it's a $50,000 portfolio, I want to keep the commissions to $1,000 for the year. So that's about $3 per trade. So with Interactive Brokers, I can do that. My average trade commission right now is about $1.05, I think. Something like that. So I'm able to get below the 2%.
By slippage, I mean difference between your estimated price versus, that's where your limit orders and open, market on open or market on close
Right.
eliminates any slippage.
Yes. On the Toronto side, what I try to do is I try to look at the price that it opened at, and I try to get filled at that price.
So by limit.
Yeah, so I'll put a limit order in at the price it opened, and then I'll wait.
Just wait.
Yeah, and it usually happens, unless it's taking off or something. But in general, or if it's come down, then I'll buy it at a better price. But if it's kind of just trending sideways, then I'll put a limit order in at the open price and then see if it fills. Yeah. With dividends, what I found is that the backtesting engine is not, at the moment, is not aware of the dividends coming up. But let's say you have a dividend tomorrow. You need to adjust the limit price by the dividend amount, because the price of the stock is going to drop by the dividend amount. But the problem is the backtesting engine doesn't know that, so it's going to give you a limit price that's higher. Basically, you might get filled at a price that's not as beneficial. So what I started doing is I put a flag in the backtesting engine to say that there's a possible dividend coming up, just by looking at historical pricing information. And if I see a possible dividend, then I look at the dividend calendar. If the dividend's happening tomorrow, then I make sure I adjust the limit price. Yeah, we talked about commissions already. I was just going to mention, if you're not familiar with these type of orders, basically they're like auction orders, right? Where the market is matching orders before they open. So with market on open and market on close orders, you have to have the orders in by a certain time, in the morning or the afternoon. And then if you, after that time, you can't cancel it, and you can't cancel it or replace it. So with a market on open, with NASDAQ anyway, it's by 9/28, you have to have the order in, and then NASDAQ starts disseminating the order and balance information, and they start balancing all the orders, and then at 9:30, that order will be placed immediately. Every market on open order I've placed has been filled like at 0 seconds.
Wow.
9:30:00, right?
I know a guy that used to trade when I had my trading floor. He came off the national bank, and he used to trade the imbalance.
Oh yeah, yeah, you can do that. Yeah.
That's interesting.
Does it only work for NASDAQ? Does it go for Amex or New York?
New York has it. I don't have the rules because I haven't used it. It's a little bit different. And the market on close, I don't typically use them, but for those you have to have them in by 3:55.
Well, I thought it was 3:45.
Well, it is for NYSE, for the
NYSE.
yeah.
Okay.
But for NASDAQ, it's
because they
later.
have each exchange has their own rules.
Yeah. Yeah, it's slightly different rules, but with NASDAQ, it's 3:55.
Okay.
But what I really like about them is that you can do them the night before, and you don't have to worry about price fluctuations because it's an auction locked-in price right at the open or right at the close.
You're going to get the same price that your most charting packages show too, right?
Right. So that bar you see right at the open with all the volume, that's the market on open order. And whatever that price you see, that's the one you're getting, or maybe a little bit better.
And there's nothing like that in Toronto.
No, they have it. I've looked into it. Yeah, I haven't IB probably supports it. I just haven't tried it. The other problem I have with IB is that, like I have a locked-in retirement account. IB doesn't support them, right?
They've just started doing registered accounts.
No, I can do an RSP, but not the pension type accounts.
Oh,
Maybe they do now, but when I first looked at it,
yeah, straight RSP. No, they just.
yeah, I have an RSP with them, but the Lira is not something they had.
What I don't like for interactive brokers is you can trade Canadian stocks. But if you got some of the smaller priced ones, like $1 a share, and you've got to buy like, you know, thousands of shares, with interactive brokers pricing, it can be like $200-300.
Oh, the commission is crazy, yeah.
It's crazy. So then you're better off to go to a Canadian broker to do that.
Yeah.
Max out at $10.
Yeah, so I do most of the Toronto trades I do is through CIBC, Investor's Edge, and they're like $6.95 a trade. So yeah, I can buy 20,000 shares of something for $6.95. And from my experience, the fills are they're fine as long as you use limit orders. And
Any questions?
I was just gonna say on your strategies that you're using when you've got, say, 5 positions and you're going through it. When you're selling, do you sell because something's been knocked down to position 6, or do you just like in broker terms, this lowest rank held, but you rank everything, and then if you bought it, but you'll hold it, you know, you're holding 5, but you hold down until it gets to the 12th position before you sell it.
right. With mine, the way I do it is the shorter term one anyway is just a time limit. So if it's been held for 4 days, then I sell it. I don't sell it if it like loses rank or anything like that.
Do you have a profit target too, or is it a straight time exit?
Well, I do have a profit target, but it's way up.
Okay.
And it's only been hit maybe 5 times in 20 years.
Those outliers.
Yeah, the
Gotta love those
outliers. But I had Melee, Mercado Libre. I had
Nacho Libre. The movie.
yeah. No, it's different than that. That hit, it almost hit the sell limit, but I haven't had one hit yet. Only in backtesting.
So it's basically a 4-day hold, basically, or
A 4-day hold unless I hit the stop. So when I enter the trade, I calculate a stop based on the range, ATR kind of thing. And if it hits the stop when it closes, so if it closes below that stop price, then I'll sell it the next day in the morning.
you have a trailing stop.
No, it's just market on order, market on open order to exit. But like I said, a lot of the time I'll have a re-entry on that same stock, because even if it's dropped in price, it can still rank really high. Because you know, I look at momentum maybe over 6 months. The momentum still looks great, right? So like for instance, this morning I sold out of AMD at the open, and then I got filled almost right away with AMD again at a better price, and then it just ticked higher the whole day. So it does work out pretty well sometimes.
And now you know why you do automation.
Exactly. Yeah. That's where automation really helps.
Yeah.
Yeah. Yeah. So you're not watching all these like little price
You're not
moves.
second guessing yourself.
Exactly. Yeah.
So, so guys, I just want to thank Gary for coming. I appreciate you taking the time to talk to this group, because you're not an AmiBroker guy, and for like putting together such an awesome presentation. So I just want to say thank you.
Thank you.